All right, here we go. Good morning. It's 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets, China Open. I'm David Ingles with Annabelle Droulers.
Our top stories, Asian stocks slipping as a global rally stalls, ending a 9-day winning streak fueled by hopes of Fed rate cuts early next year. The Shanghai Composite in danger of falling to a 3-year low, with China's property slumps set to remain a growth drag into 2024. Plus, full-year sales at ByteDance set to surge to more than $110 billion, overtaking arch rival Tencent. That's going to be really one to watch, Tencent, then at the open of trade in just about half an hour's time from now. But the focus really in the session, we've got a couple of different factors. There's really the Fed, where they're watching expectations around rate cuts. That sort of seems to be fading a little bit, pulling back.
Yeah.
And then, of course, that just ongoing malaise in Chinese equities.
Yeah, just when you thought the floor was in.
Yeah, it's not.
It keeps setting a new floor, doesn't it? And yeah, and certainly to your point, right? So the CSI 300 is back to what, 5-year lows?
Around about.
Thereabouts, right? And
yeah.
The Shanghai Comp, to your other point, which you just mentioned at the top of the show, is within a few points of taking out this, and we'll show you that chart in just a moment. There is 2022 low. And below that, we're actually back to levels at the start of the pandemic, before, of course, all this monetary policy kicked in and just put a rocket underneath most equity markets, including, of course, Shanghai Comp. We'll talk more about that later. We're looking at U.S. futures, why not? And the bounce that we did see, of course, we are seeing right now following the worst day. Can we have a look at the next board, please, if we can? Thank you so much. The Kospi Index, and within that, of course, we're looking at trade numbers. First 20 days of trade just coming out earlier on. You have PPI coming out. You have a rate decision over in Indonesia. Flip the boards, please. Let's have a look at commodity markets, where I think the focus still remains in the Red Sea. A bit of a pullback in energy prices. Gold has been flirting at about, of course, its all-time highs. Iron ore is actually slowly moving up to retest its highs of the last, year or so. 135 right now in iron ore prices. Yields, okay, here's the story. So JGBs, of course, yesterday traded below 0.6% for the first time in months. We're still holding at those levels right now. Pickup in yields in the 2s and the 10s. But the rally, as that's concerned, of course, is continuing across the Asia-Pacific. To Belt's earlier point, we did also get, and the big story overnight, were the inflation numbers coming out of the UK. So a massive miss there. In fact, it matched the biggest variance to estimates in at least 20 years. Hence, when you look at cable, for example, was the biggest decline overnight. We're trading at about a 3-month low on the pound against the euro, for example, in about 3 months or so. 126.46 is where we are as far as that's concerned. And dollar China, the fix will be out in about 12 minutes from now. Focusing on that, of course, resuming some strength after what's really been, Bell, a period of weakness across the Chinese currency this week so far, at least.
Yeah, it's been really interesting because I think out of all of that hope and exuberance we had seen around the expectation that the Fed would start to cut rates, and we had that global rally, okay, yes, it stalled overnight, but China really missed out on that, and we didn't see it really catching into it. It's interesting as well because when you talk about people and their expectations, and anyone that's sort of remotely positive on the outlook for Chinese stocks going into next year, one of the factors that they're citing is the expectation that the Fed will cut rates, but that still hasn't translated into the market trading so far. But this chart really puts it in perspective here, because you've got the Shanghai Composite really in striking distance now of a 3-year low, and the level to watch on that one is 28.8643. So we'll see, of course, if we get to that. But certainly when you take a look at futures, it is guiding for a weaker start in the session so far. So let's bring in MLife strategist Mark Cranfield now to get more on the outlook for equities in China. So Mark, yes, there's some concerns here around the economic outlook, but just how much lower, okay, maybe it is hard to call the bottom here, but how much weaker can we go from here?
Well, it's very hard to say when is a great time to come back into China equities when there's been so many false alarms this year already. I mean, it's been one of the most frustrating signals for many analysts all year. How many times have people tried to call the bottom on China stocks just this year? And then the equity markets go even lower again. So it's a very frustrating experience. It could go on for some time yet. There's been a report this week that the so-called loosening of monetary policy by the China Central Bank hasn't gone nearly far enough. By some measures, in fact, they've actually, in a way, really tightened policy because of the liquidity injections just simply not being large enough. So although absolute levels of interest rates are lower in China, because of the effect on money markets, it hasn't really done much to really distribute the money across a system where it's really, in a way, it's broken because the transmission system is not working very well when you have a lot of companies, particularly in the property sector, who really are not functioning very well because of there's not enough turnover in their underlying market. So you have a whole series of things which are knocking off against one another, and until there's some kind of a united approach between the Chinese authorities, between the central bank and between other regulators, it's going to be very hard to convince investors that everybody is pulling in the same direction. There seem to be little bits and pieces going on here and there, but not enough to improve sentiment overall. And that's one of the reasons why people are gradually losing faith in a rebound. Even though valuations are very good, as you say, we're at multi-year lows, none of that really matters until you convince people that all the right people in China are all pulling in the same direction at the same time.
I guess we gotta wait on that. There's another market story, Mark, that keeps giving the disinflation narrative, or the notion that rates will fall next year. I mean, we heard from Mr. Harker talking about maybe the Fed needs to start moving lower on rates. Didn't give a timeline though, and also the UK inflation print, which was, I guess, in many ways a big boost as far as that disinflation story is concerned. Your thoughts on both, Mark?
Yeah, exactly. I mean, you've had Jerome Powell laying out the case where not only does he think more than enough has been done, he's been justified his outlook for lower rates with the dot plots, which clearly indicate lower rates from the Fed. And then you get a UK inflation print, which, as you say, came in below all the estimates. And so when you've got the data backing up what you previously heard from the most important central banker in the world, it's no wonder the bond markets are getting very excited about the possibility for rates not just going down next year, but a long cycle of rate cuts. We've had a very long tightening process. It's been the most aggressive tightening from the Federal Reserve for a couple of decades, and other central banks have followed. So traders will be expecting that to reverse, and possibly even to reverse all the way back down to where rates have come from. That's probably a bit too optimistic, but certainly if you continue to get data which comes in like that, we've got this Friday, we've got some important PCE inflation data, which the Fed watches very closely. If we get another soft print there, the bond market is going to love it, and it will continue to be a big story for next year.
Mark, great stuff. Thank you so much, Mark Cranfield, there in Singapore for us. Staying on just monetary policy, of course, in emerging markets, we have two things today. Indonesia set to hold prolonged pause there, and of course, Turkey is also on deck today. I think they are expected to hike interest rates as well here. China, of course, within the EM conversation, still very much a key focus going in 2024. What does that economy look like this time next year? Let's talk all things EM and maybe more. Trin Nguyen is with us here, senior economist, EM Asia at Natixis. Good morning.
Good morning.
How are you?
I'm doing great.
How do you feel about 2024? What are your strongest conviction calls?
Well, we know 2023 was a bad year, right, for most of emerging Asia except for India. One, China demand was worse than expected. We didn't get that impulse that helps the rest of Asia. It was actually negative, a drag. The Fed was worse than expected. Instead of cut, we got hike. And of course, the ICT cycle was on the downturn. So all these things really crushed the big traders, crushed those that had a lot of debts that couldn't do it. So I think a lot of these trends are reversing. We know the road forward is very bumpy. I think, and we think that markets are ahead of itself in pricing March cuts, but the cuts are coming likely in May, and the cuts will help us. They will help us, particularly countries that felt a lot of pressure, right? You already saw the reactions to JPY, Korean won, the heavy debtors with weakening demographics that didn't really have the chance to really follow the Fed, right? Really desynchronization of economic cycles. So I think the low yielders will enjoy quite a bit of respite. And also across Asia, including Indonesia, which is a high yielder. The fact that it felt a lot of pressure as the interest rate differential. So that will help it have more monetary independence. Okay. The second on financial conditions easing is really the trade cycle. Today, we saw really good news from South Korea. Another good news, double digits increase, and the good news is actually helping via chips. And the China decline, instead of double digits, is in a single, very low, close to zero decline. So that's very good news because we have this upturn of the cycle, and that's the highest value item for Asia, right? The deflation you're talking about, the goods deflation in the US, the EU, BOE in China, and so on and so forth, is actually really negative for us this year, right? Because on a price perspective, export earnings were down, and that should actually start to move higher, even if we think that global economic growth is softening in the US, EU, and even China, because the fact is that the cyclical factors will help a lot of countries, and whether it's Malaysia, Vietnam, Korea, Taiwan, semiconductor, ICT is really the highest value item, and that should help the recovery in Asia.
So if the Fed and inflation were the sort of key trends for 2023, what do you think is going to be the key word or theme we're going to be discussing next year?
I think the key theme will be normalization, right? So I think 2024, it will be the great year of normalization, and then we're going to normalize at a higher level. Obviously, for rates, we're not going to go back to zero, but the normalization will give us some respite in Asia. So it's going to look a little bit better than what we think, right? So the headlines generally can be extremely negative, especially for China. But the negative news, in my opinion, will actually translate to better positive news in 2024 because at the margin, they will soften on the policies, right? Let's not forget China tightened quite materially. And even if it eases this year, it only has space to cut by 40 basis points. And we think that the big stimulus disappointment is there in markets. But at the same time, the worse the data is, you should translate to actually a gentler handling of the economy. So on a real economy basis, it's hard to say whether or not that would translate to euphoria for investors. But at the very least, we should have better imports from China. That should translate to better performance for the Southeast Asian countries that suffer quite substantially. That should translate also a stronger yuan should translate to better tourism. So Thailand should enjoy. So I think all those factors should help quite a bit.
Yeah, I was actually going to ask you, do you think we should expect that impulse to come through? Well, tourism for some economies, and of course the trade cycle, the import cycle from China, do those things come back in a big way next year? And why, if so?
I don't think it's a big way. Well, what I would say is that at the very minimum, it would be better, right? So it's
but
hard.
It's a very low base, though.
Exactly. So that the strong conviction is that we at least will have a very low base, and the normalization, if you look at the consumption data, it's actually normalizing, right? The high growth, the headline growth for China actually masks a lot of weakness, and I think that weakness will dissipate quite a bit. And also, it takes a while for China to recover from zero COVID. The kinks from tourism are actually being removed, both from China itself in terms of flights, visa, and so on and so forth, the easing both outbound and inbound, right? So I think that would help. But given the fact that the wealth effects is a little bit negative, the spending per pocket will likely be lower. But let's not forget that also Asian economies have been proven rather resilient, despite very weakness of China. Of course, it's it hurt quite a lot of it, but it coped by also diversifying, right? So, Thailand, for example, diversified quite substantially. They've been trying to attract India, Malaysia, countries across the world to come. So I think that the normalization also is a bit of countries realizing you can't have all your eggs in one basket, and I think that's what zero COVID helped us.
India has really been the key beneficiary out of that, or one of the key beneficiaries in this region from diversification, that trend. Is that sort of set to continue, do you think, into next year?
Absolutely. I think India is our key conviction call. It's on a structural bull trend, right? The stock market can go up and down, but I think the trend will go higher. One of the key reasons is very simple. If China is plagued by debt, demographic, and deflation, India is the opposite, right? It has favorable demographics. It has very low debt. Corporate debt is about 54% of GDP. In fact, it was about 58% in 2012. So it's actually de-lever, while the rest of the EM actually took on a lot of debt during this low interest rate environment. So this banking balance sheet is actually quite strong as well. And of course, because of the demand stories, right? What's really missing is, of course, as we know people are not enough. You need investment to raise the capital stock per worker. And India is working on that, right? Through the policies, and it's yielding geopolitical dividend. For example, in Russia being kicked out of the JP Morgan index allow it to also have space to increase its weight. We're going to have an increase of passive bond flows into India. Equities have been a key driver of the flows, but I think bonds will be a key driver. Not only that, I think there's a financialization with households increasingly participating. If you look at the households' ownership of mutual funds, pension funds is increased. So India is going to have more investors, not just foreign investors who are coming in through portfolio flows, but also domestically people will invest. And that, if you look at the CapEx cycle, I think we're only at the beginning where it started with the government infrastructure, focusing on energy sectors and so on and so forth, which is desperately needed. But it's going to percolate to the private sector, and they absolutely need it because that's really where the productivity is, that's where the job growth is. And I think it is really just at the beginning. So if you look at the fundamentals of India, you'll see that it's at the beginning of this investment cycle bull run, and whether or not Modi will succeed, and markets think he will, to continue his plan, we are going to see that. And I think the geopolitical aspect of it will help. And also, the reality is China's rise is actually, in a way, pushing India to also do the same, that it also can invest in CapEx and it's at the beginning of its cycle to do so, right?
All right, Trin, thanks so much for your time this morning. That was
Happy
Trin.
holidays.
Happy holidays, yeah. Trin Yuen, EM Asia senior economist at Natixis there. Just to note, we just had the fix coming out a little bit stronger than what had been in the estimate there. So the reading 7.10.12 versus the estimate for 7.13.96. Of course, the yuan, the big underperformer against its Asian peers in the session yesterday. Still ahead, we'll get the outlook for upcoming high-stakes presidential elections in Taiwan. The chair of the Center for Asia-Pacific Resilience and Innovation will join us later this hour.
Yeah, plus we'll take you to Macau, and a revenue rebound could be in sight for the gambling hub here. Of course, we'll get you the latest in the outlook from Bloomberg Intelligence. That comes up next as well, counting down to the open of trade. 14 minutes away here in Hong Kong. Cold Hong Kong, I should say, in Shanghai and in Shenzhen. This is Bloomberg Markets, the China Open. Good morning.
Just over 10 minutes away now from the open of mainland equities and the start of trade here in Hong Kong. But futures, of course, if they're any sort of guide, we're setting up for a weaker session here today, and not a great lead in either when you take a look at the key levels we're at on benchmarks here. The CSI 300 near a 5-year low. The Shanghai Composite as well near a 3-year low. So certainly concerns still around the economic outlook and the health of domestic companies. But one, of course, that we're very much focusing in on today is ByteDance, because Bloomberg has learned that the tech giant's sales topped $110 billion this year, and that would potentially overtake rival Tencent. Let's get more on that now with Bloomberg's Greater China Senior Executive Editor John Liu joining us from Beijing. John, thanks so much for joining us this morning. I think, yes, these results are unaudited, but it certainly does tell you that ByteDance has really catapulted its position over the course of this year.
I think it speaks to how successful a product the company has when it comes to TikTok, when it comes to Douyin, the Chinese version of that short video app, how addictive it is for the user, and also how effective it has become as an e-commerce platform. That is where all this growth is coming from. It's not just here in China, it's also in the US and elsewhere. ByteDance is becoming a bigger player here. That is being illustrated by the fact that it is on set to surpass Tencent in terms of revenue.
Right. And John, since it's obviously not a public company, and to Belle's point, not audited results, how much do we know about other financial metrics of the company, things like profitability, for example? Because that, I guess, in some ways might inform us whether over the longer term the company can actually start challenging some of the other incumbents, of course, in other markets.
So we do know there was a Financial Times report earlier this year that said its earnings before interest, tax, depreciation, and amortization in 2022 was $25 billion. And so we also know that revenue in 2022 was in excess of $83 billion. And so that gives you a sense if revenue this year is more than $110 billion, what the profitability profitability might look like. You can extrapolate. I think also the fact that the revenue growth is about on par, but looks like it could be a little bit faster than it was in 2022, I think says volumes about, again, how viable this business is, given the relative weakness of the Chinese market we've seen.
John, thank you so much. John Liu in Beijing for us. Now, staying in tech, Micron, in case you missed it overnight, giving a strong revenue forecast on the back of growing demand for AI chips and data centers. And this is the reason, hence, we're looking at some of the chip stocks trading here in Hong Kong. The company sees second quarter revenue at 5.1 to 5.5. That's billion US dollars. It's above estimates of 4.99 billion. Now, Micron expects a quarterly loss of 21 to 35 cents. That's narrower than the 62-cent projection coming from analysts. The CEO, Sanjay Mehrotra, is reiterating his prediction that 2024 will be a rebound year for the industry, setting the stage for record results in 2025. Right, brief look at some of these tech stocks we're trading already in Taiwan as a function of this, but I would imagine declines here are more a function of the direction that the winds are blowing across Asia-Pacific markets, and that is down. Okay, a preview of perhaps a down day in Greater China. Plenty more ahead. This is Bloomberg. Thursday session, just 40 seconds away. Declines are likely going to be the name of the game, and in fact, sharp declines as pertains to Hong Kong. And we talked about Tencent down 1%. That's, well, Tencent's down that much, that's what happens to the index. A50 futures, I mean, it's also worth reminding our viewers that yesterday actually saw some very sharp declines onshore, where the CSI 300 5-year lows, and of course Shanghai Comp Bell, right, on track to, we just could take this out, this 2022 low.
Yeah, we really got to watch that key level. That it is 2886.4, the key one to see if we do have the Shanghai Composite here opening at a 3-year low. It's pretty interesting when you put it as well in the context of all that optimism we had coming into the year, because traders were a lot more positive on the outlook for Chinese equities, but certainly hasn't been the story over the course of 2023 trading. So just taking a look at how we're trading so far for the Shanghai Composite, we are just pretty flat as we come online, so we're not really seeing any of those that low being taken out so far in the session, but of course very close to it, and you can pretty much say yes, Chinese benchmarks are around multi-year lows at this point in time. The losses we've got so far, well, it's really feeding into the tech space in particular. You can see that drop there on the Hang Seng Tech Index off 1.3%. That could be partially, of course, down to what we're hearing with Tencent on the losses there, because it's that story of ByteDance really starting to outperform that Chinese tech space, looking very crowded as well. And the leaders, those more legacy leaders like Alibaba, Tencent, they're certainly being tested in the market as well. Let's change on, just dive a little bit deeper into those sectors in China today. And again, not a great story here. You have every single sector in the red at this point in time. There is the concerns around China's economic health, and then feeding into that is just that direction from Wall Street trading as well, because it was a weaker session overnight, and so still you do have those cues that are really translating across the Asian session so far. But let's take a look at some of those stocks in particular here. So again, the ones that we're watching so far, well, Tencent, as we said, that focus, given ByteDance's sales breaking the $110 billion mark. Alibaba just fairly flat right now, but Chinese tech stocks, generally, we are seeing them under pressure. Let's change on, because chip stocks, of course, the other one to watch in the session today. We had Micron giving a pretty strong forecast after their data center demand grew in the latest reporting period. You've got other factors as well at play here. Korea as well, just putting out some pretty robust trade numbers, and of course a major chip exporter, so that could be a more positive indicator. And we are seeing these chip stocks just a little bit higher so far. Property, another key sector in focus. It does continue. A couple of headlines that we're tracking here on those names. You've got the developer China South City facing more tests after some debt relief that came through, that one unchanged at this point in time. But generally, we just got that malaise still coming through. And Venki, for instance, being given a little bit more room on private debt repayments, but still it's that story of weakness that continues in the session. Dave, the question, of course, is when we start to see the bottom, and would there be any sort of more resilience coming into the Chinese consumption story next year?
Yeah, because the bottom is, to your point, hard to call, and you often see it sort of in the rearview mirror, and then you need a series of data points to actually confirm that, right? So in some ways, because it's not clear at this point, I guess my point is it's going to be at least a couple of months before we are able to...
Or quarters.
Yes, exactly. Yes, I'm being optimistic, but yes, okay, thank you for that dose of reality, Bill. Okay, well, in terms of reality, so a couple of data points today. We have inflation out of Hong Kong, we could have FDI out of China, and we're also getting visitor arrivals today. This is for November out of Macau. That's the top part of your chart. We're basically back to norm. What has, I guess, taken more time to recover is really revenue and earnings. But according to our latest reports out of Bloomberg Intelligence, they actually see that rebound in revenue is actually in sight in the next year for casinos, right? So in fact, when our intelligence analyst here, Angela Han Lee, and this is to read about it on your screens, this is perhaps why we could see that come back in a very big way, thanks to new integrated resorts.
Yeah, that's right. Let's bring in Angela Hanley now. She's the Bloomberg Intelligence Senior Research Analyst for Gaming and Hospitality. Thanks very much for joining us again this morning in studio. Just talk us through the report and why exactly you are seeing this rebound in revenue.
Yeah, so to check on the visitor arrivals, it's about more than 70% of the pre-pandemic levels already. But in terms of the gaming revenue, what we see is that we are going to see around 22% gaming revenue growth next year from this year's level. And also that means that the gaming revenue is going to reach 75% of pre-pandemic levels. And it looks like it's not that impressive because it's still lagging behind the 2019 numbers. But if you check the mass gaming revenue, it's already surpassing the levels already. We are going to see continued crackdown or say a weakness of the junket VIP segment because credit-driven big rollers is not coming back. But at least we are seeing that the leisure travelers are doing really well. So that also means that the gaming companies' EBITDA is going to be pretty good. We are seeing that the Macau's EBITDA, property EBITDA of the city is going to be a 91% of pre-pandemic levels next year.
Yeah, well, given that it will take a few more years to return to on revenue, at least 2019, right?
Yes.
Well, first, do we have to be concerned about financials? And my other question there is, if junkets are not going to return, so that's the VIP business, should we just remove that from the equation and just basically say Macau has returned to pre-pandemic levels? I'm wondering what lenses you're looking at.
Yes, that's true. So we actually, when we do the forecast, we don't actually expect much improvement in the junket VIP segment, as you said. And also given that the growth this year has been mainly driven by the mass segment. And as I heard days ago, there was a news that the Macau government is thinking about not allowing junkets to extend credits to clients. That means that junkets are just going to become a normal, ordinary travel agents.
Yeah.
That means they are not valuable at all. So for that reason, I agree that when we talk about Macau, we actually should remove the junket VIP segment there, and also because the EBITDA coming from the segment is very, very small now. I guess it's probably less than 8% already. So on this segment, I would say yes, we don't think we have to consider that. And also given that the mass gaming segment is much more stable, I think investors will be more interested in the Macau gaming segment going forward because of the less earnings volatility. Yeah.
So is there more sort of seasonality that comes into it then? If that mass market is more important, are there going to be sort of key periods of the year or key events, for instance, that we really need to look out for?
Yeah. So in the past, the major events that we actually try to monitor to do the stress test of the Macau city is that, maybe Lunar New Year, and also the October Golden Week. But this time we are seeing that from this year, we are seeing much more crowds coming in for other smaller holidays. So even for Christmas, which is more a Western holiday, but we might be seeing more people coming in. And because there are much more events going on in Macau during the Christmas and also New Year. So before, Macau was very, very gaming driven, but now they are having much more facilities. They do a lot of concerts. They have so many amenities to offer. So some TV channels has been doing their like year-end concerts and events in Macau as well. So that is going to draw some new traffic, like young travelers coming in to Macau to join these kind of events. So we are going to see more seasonalities and like more holiday-driven leisure travelers coming in December and also next year.
Isn't Bruno Mars coming back to Macau? That's not a question for you.
Yeah, sorry, I haven't checked the event.
Oh, no, okay. But yeah, that's not my question for you. No, I saw that. Because to your point on concerts, right?
Yeah.
I mean, David Beckham was there with his casino as well. So my question is, so long gone are the days where VIPs and high rollers mattered for the casinos, and it's really more an integration of the resort. Studio City opened a few years ago. I was at the opening, and I think Lawrence Ho mentioned at that point is that they want to make this a family-oriented place that people can do all sorts of things. Do you notice other casinos changing their strategies to cater to a more integrated experience of Macau?
I think so. So usually, let's talk about the input-output ratio.
Okay.
In that sense, I will say VIP gaming segment is not that bad. Think about one person coming in, he just stays in one hotel, and he spends like millions of dollars, right?
Yeah.
But
what's Rich doing this weekend? I'm kidding. Okay,
so, but if you talk about the mass gaming segment, that means that like one dealer has to serve like several players. It actually involves much more utility bills too. So I would say in terms of the variable cost, obviously VIP segment was pretty good, and also like it's easier to handle. That's why Macau has been much more like much more VIP driven before. Now, given that the segment is not that easy, and also like there is not that easy money to make in China, that means that people are less willing to spend that much money at once. So that means like some casino operators are just forced to be more mass-oriented, not because they want it, but it's more like the situation is letting them to do more mass-oriented. So I think that's the case here, and as you say, Macau has been doing that, and Galaxy is doing that too. Everyone, and MGM China has been a really good player this year. Next year, we are going to see pretty good growth from Galaxy and SJM in Cotai side.
All right, Angela, thanks very much for your time. And I think Dave wants to let us know as well that Bruno Mars will be coming back for one night at the
That is confirmed. Non-breaking news.
All right, that was our Bloomberg Intelligence Senior Research Analyst, Angela Hanley, joining us there. Coming up, University of Virginia's Siaru Shirley Lin joins us for an outlook on Taiwan's elections. Hear how the outcome could be pivotal for China and the US next. This is Bloomberg. Argentinian President Javier Milei has announced broad reforms to deregulate the country's economy. He's also planning steps to eventually privatize state-run businesses. Let's get more on that now with Patrick Gillespie joining us from Buenos Aires. Patrick, thanks so much for staying up late for us from Argentina. But let's just get through these series of measures, because I think about 30 policies have initially been announced, but it's part of a broader reform package as well.
Yes. Javier Milei is doubling down his efforts to fix Argentina's economy through his shock therapy economic framework. He mentioned several measures tonight, which, as you mentioned, were a part of 300 policy measures that he plans to take. There are a lot of doubts already being raised about how much resistance he's going to face in Congress and how much society, such as powerful labor unions, are going to tolerate these measures. But Milei outlined a series that include privatizing state-run companies, as also opening up the economy to foreign investment, foreign land purchases, and really getting rid of price controls. So this was a huge package of measures. Some will be welcomed by investors and Argentines. Others stand to face a lot of resistance in Congress and on the streets of Buenos Aires, where we saw the first protests today against Javier Milei.
Patrick, thanks very much for your time. Of course, we're tracking very closely how Argentinian assets start to trade later today. But let's shift tack now to another important political development, because, of course, we're on the countdown now to Taiwan's elections taking place in just over 3 weeks. Let's get more on what that means and bring in our next guest, Siru Shirley Lin, chair of the Center for Asia-Pacific Resilience and Innovation and research professor at the University of Virginia. Shirley, thanks so much for joining us on the show this morning. I want to ask about the calculus for Taiwan, because, of course, the last election was held back in the beginning of 2020 rather. The dial has certainly shifted a lot between Taiwan, its relationship between China and the U.S. as well.
Yeah, thank you very much. I think, the momentum for this election has really changed quite a lot in the last few months. First of all, this is Taiwan's 8th direct presidential election. And if the DPP, the Democratic Progressive Party, were to win, which is quite likely, according to the poll, by a very small margin of probably just 35%, you will see actually a rather different kind of situation, because this is the first time the DPP will have been in its 3rd term. And the implications are quite far-reaching for both the United States and China, for a very simple reason. We have 3 candidates who are all previous mayors who actually are not internationalists. None of them speaks English very well and do not have experience in foreign policy or in cross-strait relations. But their platform is very much centered and founded, if you will, even if it's not front and center, on Taiwan's relationship with the U.S. and China. And what I would highlight is, in addition to their background, is the fact that the 2 opposition candidates are what I would term, broadly speaking, skeptical of Taiwan's position and proximity to the United States, whereas the incumbent vice president, who is running for president with the former representative to Washington, Shelby Kim, as the vice president. Together, it's a ticket that advocates having still very close relationship with the United States, upholding Taiwan's sovereignty, whereas the opposition party is very focused on solving what my center, Capri, does a lot of research on, which is Taiwan's high-income trap, meaning that Taiwan, as a wealthy society, needs to create more jobs for young people, more opportunity, more innovation, and enhance its competitiveness economically by working more closely with not only the United States, but more importantly with China, which still Taiwan's global foreign direct investment is 50% focus on in China.
What are the opportunities, granted, of course, that, to your point, the profiles of the candidates don't seem to scream foreign policy, let's put it bluntly and simply. What are the opportunities still, though, that you think will remain cross-strait when you look at business relations between Taiwan and mainland China?
So that's a good question, because all of our previous elections here in Taiwan are very focused on the question of China, especially in 2020, which for the first time, it was a landslide victory for President Tsai Ing-wen and for the Democratic Progressive Party. And much of it on the international side has to do with what happened to Hong Kong in 2019 and how China is governing Hong Kong through the one country, two system. In this election, however, it's quite changed. There's 1 million new voters of the 9.5 million voters. 6.5 million of those 19.5 total voters are people under the age of 40. So young voters is the big swing vote. If you look at actually what is happening is the discussion. Last night, we just had our first presidential, we wouldn't call it debate, platform presentation, where each of them spoke about their policy platform. And in this 2-hour televised presentation, most people talked about not about China, but primarily about how to solve the problem of domestic governance. But of course, this is 2 sides of the same coin. Why is that? Because by working with China, the 2 opposition parties says, and accommodating them, even if their values are in conflict with our way of life, This will solve many of our problems in terms of getting young people jobs, creating more innovation, and the fact is also that the United States has, of course, advocated decoupling from China in a way that is quite harmful, they would say, to Taiwan and to many allies and partners. Specifically, you can see in technology, the decoupling has cost Taiwanese companies, Taiwanese society quite a lot. And at the same time, it seems apparently quite self-serving for political leaders in the United States, as well as for the society as a whole, to ensure that Taiwanese help them onshore, create jobs in, for example, Arizona, as opposed to jobs in Taiwan. So I think in the aftermath of Afghanistan, Ukraine, Israel, Gaza, you have a lot of information in Chinese. Some are misinformation, some are disinformation that really tells you that the United States is not a reliable leader of the free world. And for us to put all our eggs in that basket may not promote peace and stability in the Taiwan Strait. So I think this is where you can see that the opposition parties' poll numbers have really caught up in the last few weeks. But still, the DPP is founded on this identity that is very important for the Taiwanese voters. So the slight lead still remains. But what we will possibly have
Shirley,
is a weakened government in the sense that that the parliament probably will not be a majority led by the DPP.
What's the best outcome then in this instance? Because if you've got that on the one hand, you've got China still, of course, offers some advantages to Taiwan in terms of proximity, cultural awareness, etc. But it is increasingly difficult to navigate that landscape. And then at the same time, as well, you've got the US, and you said that their policies aimed at technological supremacy, but perhaps haven't really been so fair or easy for Taiwanese companies either. So when you look at the chip-making sector specifically, the major exporter from Taiwan, what's the best outcome here?
I think that it's the best outcome, of course, is if we have actually an election that is not a landslide, and if you can imagine a DPP president with probably a opposition-led parliament. What we really need to see is, of course, Taiwan should be able to walk the tightrope better, and it's been very difficult in the past few years, just as it is for South Korea, for Japan. All of the technology partners and allies of the United States have really suffered to comply with U.S. policy. But I think here the DPP has put a lot of political capital to invest in the relationship with the United States with political upgrading, but not economic upgrading with a free trade agreement. And that's where I think Taiwan will hope to really be able to get into CPTPP or RCEP and work more closely with China at the same time.
Shirley, that's all we have time for, but certainly lots more to discuss, and we'd love to speak to you again. Goes without saying. Shirley Lin, chair of the Center for Asia-Pacific Resilience and Innovation and research professor at the University of Virginia. And of course, you can catch and get more on the upcoming elections a few weeks away in Taiwan. Taiwan decides a special report featuring Bloomberg's exclusive interviews with all three presidential candidates. Stay with us. Or stay at least with geopolitics here. By the way, forgot to mention this as well. Big news, of course, overnight as well. China's warning the Philippines that relations are now facing serious difficulties amid tensions in the South China Sea. Beijing accuses Manila of backing out of its commitments and causing trouble in the contested waters. And the foreign ministers from the two countries discussed the matter on Wednesday. That's after the Philippine president said Manila should revamp its approach in dealing with Beijing's aggression. Yep, plenty more ahead. This is Bloomberg. Yeah, the winds are blowing in a southerly direction across equity markets. You had the biggest drop in 2 months in Wall Street, so futures are picking up, but that that's just about it, frankly. And it's rare, too, to see the dollar weakening and equities in the region falling 0.7 of 1%. This also has to do maybe with what's happening with China. We'll look at the dashboard here on most parts of this equity market, and we're looking at declines. Last we checked, 1% on the Hang Seng Index, 0.7 of 1%, coming off lows a little bit. We're seeing a bit of a pickup onshore, though. Now, following what was quite a big drop in the onshore market yesterday, MSCI China, 0.5%, and along those lines, of course, the big tech names, Mel.
Yeah, tech's certainly the focus for us here today, and you're seeing sort of losses in that particular corner of the market here for the most part. So Tencent, for instance, off nearly 1% at this stage. But the story as well is that we had ByteDance posting a possibly bumper revenue, $110 billion, so it's surpassing Tencent, and it's that story of that tech supremacy that's really being challenged in China. That's it for Bloomberg Markets China Open. Bloomberg Markets Asia is next.